Good morning. I'm Sandy Clark with Manning Fulton, and today we're going to talk about retirement enhancements under the Secure Act. And we'll go into some of the details that now retirement plan assets should consider as far as beneficiary designation. So the good news, we're not going to talk anything political. We're not going to talk about the coronavirus. We're just going to talk about tax law, which this is one of the few times that it's more exciting to talk about that than those other subjects that have been beat to death a little bit. So we'll go over a few things, and feel free to enter any questions into the question box, and we'll try to address those either during the presentation, or if we go too long, we'll do those afterwards. I can email people afterwards. So let's talk about the Secure Act. This was established in 2019. The official name, Setting Every Community Up for Retirement Enhancement Act, and it's effective for any individuals that die after January 1st, 2020. The big thing it did, which caught most of the headlines, at least for those that read these types of articles, is it eliminated the stretch IRA and replaced it for most beneficiaries other than 5 certain class of beneficiaries. It requires the 10-year payout rule. So changed pretty dramatically our post-death planning we can do with retirement assets. A couple other things it did that a lot of people recognize that we're certainly already taking minimum distributions is it changed the required minimum distribution age that had been 70.5, and it's now you do not need to start taking those till age 72. It also eliminated the maximum year. It used to be that you could not contribute to an IRA after age 70.5, and now they removed that age limitation, so you can contribute indefinitely throughout your life, no matter what age you are. Oftentimes we find when we're planning for estate planning that a lot of times your retirement account and maybe your real estate are your 2 largest assets. So you can have a great will, a great revocable trust, all the best documents that Manning Fulton can put together for you, but your IRA generally is controlled by your beneficiary designation. So if you have an account with a certain provider, that's going to control that contract. That beneficiary form controls how that asset's paid out. Now you can name your trust as the beneficiary, but if you name one daughter, one spouse, the beneficiary, it's going to follow those beneficiary form terms rather than what's in your will and trust, unless of course your will or your estate or your trust is named as the beneficiary. So that oftentimes we develop strategies that avoid income tax, or at least minimize income tax and delay it as long as possible. So this is the one asset generally in someone's estate that does continue to have income tax implications, because of course you've not paid income tax on it, so your beneficiaries would when they withdraw it. So that's why there's such a big, this has a kind of different planning than any other asset that we have for most of our clients. Under our old law, again, the objective was how long can we delay it? Name grandkids, they have the longest life expectancy. You can delay. This was called stretching out your IRA. So if a parent named a child as a beneficiary and the child was 50 years old, that life expectancy was 32 years. They could pay 1/32 of the IRA out each year, and that way delay the income tax implications on it. So that was where the term stretching came into place. And of course, naming a grandchild or someone younger than 50 even stretched it out longer. So you can see that mathematically we could stretch these out and have little income tax effects year to year if you're not taking out big distributions. There was under the old law, there's a 5-year payout for non-individual beneficiaries. So these are people that aren't named. There are certain rules where a trust can be considered, looked through, and the individual beneficiaries are deemed the beneficiaries. But anytime you'd have an estate or charity, they are non-individual beneficiaries. Under the old law, they had a 5-year payout. That's still the case. So if you either don't name anyone, so your estate's the beneficiary, or you name a certain charity, those are going to have to be paid out within 5 years. So normally a charity wouldn't mind. They don't pay income tax anyway, which makes them a very valuable beneficiary for some people that want to have charitable goals. But even if you didn't fill out your beneficiary form, it would go to your estate, and that would have to be paid out within 5 years. So again, reducing some of the flexibility and delays that you can have for income tax based. So what's our new rule? The 10-year payout applies. You used to have to determine whether the individual had met their required minimum distribution age before you could determine the life expectancy and the payouts. The 10-year rule, that no longer you have to look at whether the decedent had already obtained their required minimum distribution age. There's a 10-year payout, except for this 5 class of individuals that I'm going to talk about in just a second. So how the 10-year payout works, you can either take it all out in year 1, you can take 1/10 each year, trying to compress the income tax brackets. You could delay as long as possible and do the non-taxable growth as long as you could, and just take it out by December 31st of the 10th year. It's not a calendar year based on when the individual died. It is a 12/31 year end. So the 10th year is defined as December 31st of the 10th year. So you have some flexibility within that 10-year period. We mentioned there's 5 classes of individuals that can avoid this 10-year payout, and these are called eligible designated beneficiaries. Oftentimes, you'll see them designated as EDB in tax articles. The big one is the surviving spouse. So still the surviving spouse has the most flexibility for beneficiaries. So oftentimes, if you're thinking about naming a beneficiary either as a spouse or a spouse in trust, they have the most flexibility. So again, they would still take it out over their life expectancy. So if my husband were to name me as his beneficiary of his IRA, he passes away, we determine my life expectancy based on the IRS tables as of the date he passed away, and I would take out payouts based on that life expectancy. The other classes are minor children, disabled individuals, chronically ill individuals, or individuals that are not more than 10 years younger than the decedent. These again can take it out over their life expectancy. The EDB status for those 5 classes of individuals is determined as of the decedent's death, with the one exception being the minor child. So if I name my 3-year-old as the beneficiary of my IRA and I pass away, the minor child from age 3 to 18 in North Carolina is when majority is determined. From 3 to 18, they could take it out over their life expectancy. Once that child reaches 18, they'd have to take it out 10 years after that. So by the time they're 28, or December 31st of the year they turn 28, they would have had to take out all of the IRA distribution. We'll talk a little bit about some trust planning with minors, but some people are okay with that. The problem is, for planning purposes, if you come to me and you have a child that's 3 years old, we don't really know what their spending aptitude is. We don't know whether they have marital issues, other issues that would make it not proper for them to get a lump sum distribution and control of these assets at age 18. So that's where maybe some trust planning might still be needed. So you got to balance between the ease of just naming individuals outright to having the control that you think is necessary for certain beneficiaries. So again, we mentioned surviving spouse has a lot of flexibility still under the new law. Surviving spouse continued to take distributions over their life expectancy. You could do a spousal rollover. The 10-year rule begins at the rollover if you prefer to put it in your name. But you can certainly take the surviving spouse beneficiary assets over your life expectancy. Sometimes you want to control the ultimate beneficiary, so you're fine with your spouse taking funds out as they need it, but maybe it's a second marriage, or for whatever reason you want to control the ultimate beneficiary. You don't want the spouse to be able to control completely how much is taken out, and the ultimate beneficiary after the spouse dies. Often that's needed in a second marriage situation, so you could still have a trust that benefits the spouse. If that spouse is the sole beneficiary during their lifetime, it's called looking through. You can look through the trust and determine that the spouse is the beneficiary, and you could still pay it out over that spouse life expectancy. So you would not be bound by that 10-year rule out with the trust in those terms. If you had the spouse and my children as the beneficiary, then the spouse is not the sole beneficiary, of course, and the 10-year rule would apply. Let's talk a little bit more on minor children. So again, minor children, depending on what state you live in, the ages range from 18 being the most common age of majority, up to 26. There's 2 states that have age 26 as their age of majority. A few states have 21. 18 is the most common. So if you move out of North Carolina, that could change your impact if you name just a minor child outright. So if I name my minor child Will as my beneficiary, he's a minor. We paid out of his life expectancy till he reached 18, and then at 18 we could either delay it till December 31st of the year he turned 28, or take 1/10, or take it all out in year 2. But as long as we took it out by the time he turned 28, well, December 31st of the year he turned 28, we would be in compliance. The rules for non-compliance are pretty heavy, so, and the penalties are like 50% of the amount paid out. So certainly these are rules that they're punitive if you don't follow, and following them would be, in everyone's best interest. There's also within that 5 class of EDB beneficiaries is disabled individuals and chronically ill individuals. Disabled individuals is a statutory definition that's defined. If you're on Social Security disability, you'd meet that definition. If you maybe have a mild form of Asperger's that limits your ability to have a job, but you've not applied for disability, you may not meet that. So it's defined by federal statutory laws, but generally Social Security disability would be required to be deemed a disabled individual. Chronically ill, again, fits within that EDB, 5 classes of EDB beneficiaries. That definition is governed by statutes also, and generally requires a licensed healthcare practitioner to certify the requirements. The requirements are similar to what would apply if you were trying to get Medicare or Medicaid, and that you meet certain medical conditions that you cannot take care of yourself. So if you're living at home and still independent, you're probably not chronically ill, but if you're in a nursing home, you probably are. So again, those individuals would be able to take it out of their life expectancy. We mentioned that there's still opportunities to plan with trust. So what happens on a trust is you can look through the trust to determine who the eligible beneficiaries are. And if they meet the definition of EDB, then you could still do the stretch out and pay out over life expectancy. But it has to be for the sole benefit of that eligible designated beneficiary. So if I name my children as the beneficiary and only one is a minor, what we could do is have the ability within our trust to immediately divide those among my 2 children. My 1 child that's not a minor would have to be paid out in 10 years. If I had another child that was a minor, we could divide that share out, and then that share could be paid out over life expectancy till they're 18, and then after 18 paid out over the 10-year period. So oftentimes in our trust, we have the ability of a trustee to divide immediately on death, and then that way you can still look through and determine the beneficiaries and determine if any of these eligible designated beneficiaries that could take it out over a slower time period. Under our old law, oftentimes you may have not known what type trust your planner was putting in place for you, but there's two basic types of trust for retirement plans called a conduit trust or accumulation trust. Under our old law, the and again, these two types of trust allow for the seeing through to the beneficiary. Under the old law, conduit trust was the most popular type trust for most planners because the trustee paid the beneficiary the required minimum distribution. So again, if I had my 50-year-old beneficiary that had a 32-year life expectancy under the old law, the trustee would take 1/32 of the trust proceeds, have it paid to the trust, and have that flow out to the individual beneficiary. And then that way we've minimized the tax implication. The trust would flow through the income to the beneficiary, and the beneficiary that received the funds would pay it at their income tax rate. So while trust and individuals have the same tax rates, where the maximum tax rate still is the same amount, the income brackets are compressed for trust, and they reach the highest tax rate at about under $20,000. So a trust earning $20,000 would be paying the maximum 36% tax rate, where an individual has to be over like $150,000 before it gets to that same income tax bracket rate. So oftentimes the conduit trust under the old law was the best method of paying. The other type trust, and it's called as accumulation trust, means the trustee can either hold it or distribute it. So under the old law, if they took out that same 1/32 of the retirement funds for the 50-year-old, the trustee could say, I'm going to keep it myself, we're going to keep it in the trust, or I'm going to pay it out to the beneficiary. Again, sometimes when the trust holds the funds because they've not paid it out, the trust pays the income tax on it, which can result in a higher effective income tax. Conduit trusts, again, often used when you want to pay out all the minimum distributions. Under the new law, because again, in the 10-year period, you could either hold funds, pay out funds. In the 10th year, the trustee can determine what's the best method of doing that. Oftentimes, an accumulation trust is a little bit better method in that if they wanted to take the funds out but not pay it to the beneficiary. So again, if I have a beneficiary that has a drug addiction problem or in a terrible marriage, I don't probably want to pay them out all the IRA benefits in that 10-year period. Maybe there's reasons such as those that during that 10-year period they shouldn't receive anything or should receive only a minimum amount. Under an accumulation trust, the trustee can just hold the funds. So again, while they'd still have to take it out from the IRA holder during the 10-year period, the trust could hold it, pay the tax on it, and then that would just be how the trust would be operated. So that's an accumulation trust. So some of our trusts we have modified after 2019 just because of those reasons. Many of our clients, they're okay still staying with the conduit trust language, but something to think about. Again, this kind of describes some of the delays in paying out beneficiaries to a trust, which is permitted under the accumulation trust. Keep in mind, if you have a trust that's for a minor or a chronically ill person or a disabled individual, let's say we have a supplemental needs trust and my individual is disabled, we could still pay it out over that life expectancy. And I say pay out, the holder of the IRA has to pay out the life expectancy amounts to the trustee, but the trust could hold it. So if my disabled individual shouldn't receive any of these funds because they're on a qualified governmental plan, they're eligible for Social Security disability, and they don't need these funds to live on, then it's possible the trustee could say, okay, pay out the life expectancy amount to me, pay it as slow as possible so that the trust pays as little income as possible, but I'm going to just accumulate these funds and hold them and not distribute those to the beneficiary because that's not in the beneficiary's best interest. So again, the accumulation trust gives a little bit more flexibility But just because you either have a minor child, a disabled individual, or a chronically ill individual, you could still use a trust and wouldn't be bound by that 10-year payout if the beneficiaries meet those definitions. So still some good planning opportunities. A couple other things that the Secure Act did is, under the old law, you were allowed to make qualified distributions to charities, and you could only do it after age 70.5, and it would reduce the amount of your distribution. So if you were 70.5 and you wanted to pay out $50,000 directly to your church, you could do that. It could count towards your minimum distribution. So you would avoid the income tax on the $50,000 that you had sent to the church, but you also would not take a charitable deduction for that. So it would just be a clean wash, but it would avoid, in that case, having to take the required minimum distribution. Keep in mind that they did not change the age for qualified charitable distributions to 72 like they did on the minimum distribution age limitation. So even though you're 70.5 and you're not required to take minimum distributions yet, you could do that for that 1.5 year gap between the two different statutes. Again, age 72 is when now you're required to take required minimum distributions, but the qualified charitable distributions I just described, you're eligible after age 70.5. So many of our clients that have charitable plans have done this to, again, avoid paying the income tax on the minimum distribution requirements. One thing they did, because now you can contribute to your IRA indefinitely throughout your lifetime without any age restriction, they did apply a limitation that says if you take this qualified charitable distribution and in the same calendar year you also make an IRA contribution, you have to net those amounts. So again, if I pay out $50,000 to the church as a qualified charitable distribution when I'm 73, but also make a contribution of $10,000 that I'm going to take as an income tax deduction on my tax return, the qualified charitable distribution is reduced by the amount I put on my tax return as a deductible IRA contribution. So they don't want you in that same year taking funds out, going to charity, but also making a tax deduction IRA contribution. So a couple little rules to follow there. A few other provisions. Again, we mentioned the change in the required minimum distribution to age 72. They've allowed, so in 2019, there were several provisions that allowed for penalty-free withdrawals, but there is now a penalty-free withdrawal for $5,000 a year of birth, and also for adoption. In 2019, they also allowed a delay for making the IRA contributions that usually is April 15th of the year following. So again, now I can make a contribution to my IRA at any time up to April 15th. I can make an IRA contribution and designate it for 2020 because the pandemic was starting during that time period. Last year they had a delay in that April 15th date. We're not expecting that this year. So again, if you plan on making a contribution for 2020, I'd make it before April 15th because we're not expecting that there'll be a provision for a delay, since I think we've gotten used to the pandemic somewhat. A few other provisions they've added: that a 529 account may be used to repay up to $10,000 of a beneficiary's student loan as a qualified higher education expense. They've also they tried to make it easier for small employers to develop 401k plans and to do a kind of a group or mass defined one. We've seen some of our clients use that. So again, the idea being they want to make it easier for employers and also maybe make it easier for older individuals to contribute and use their IRA funds. The individuals they're not so concerned about making things easier for is beneficiaries. So again, beneficiaries, they are expecting now, unless you're within those 5 individual classes of EDV beneficiaries, to be paid out in 10 years. So still a lot of planning opportunities, still a lot of trust. We probably need to focus maybe more even on retirement planning now that we've got some limitations on who can stretch these out. If you have a large IRA account, you might want to talk to your estate planning attorney, find out what kind of trust is being used, and will you be able to stretch that out. So certainly smaller IRA accounts you wouldn't need to worry quite as much about, but a lot of times it's your biggest asset in your estate plan is your IRA account. So looking at these beneficiaries in the trust is one of the primary focuses that we have for estate planning. We also thought last year there might be a lot of Roth conversions, which we know at least some of our clients took advantage of that. We don't know if the income tax rates are going to increase under the new administration. Some people are concerned about that, so maybe converting Roth IRAs before any new legislation went into place might be a valuable tool. We're not sure now that we're in 2021 that if they did enact new tax rates, those might be retroactive to January 1st. So that's something to consider also. One thing we always try to mention with some of our clients, if you're charity inclined and you're going to make a charitable disposition from your estate, consider whether that should best come from your IRA account, since again it comes income tax free to the IRA beneficiary. So if they're a charity, so you leave $50,000 to your church, they get the full $50,000, whereas you leave $50,000 to your estate, the estate pays tax on it. So then it's only worth, let's say, $40,000 or $35,000, and then from that fund and other funds, it'd have to come up with the $50,000 to go to the church if it's just in your will. So that concludes our presentation. I've got my email up. Feel free, if you have specific questions, feel free to email me. I'd be glad to help address any questions you have. And we appreciate your time. And thank you as always for tuning in and listening to our Flashpoint. Have a great day. Thanks.